Hi, this is Dennis from Never Stop Trucking. We're going to be talking about fun topics today, which is taxes. It's beginning of a new year, and everyone has to do taxes, and that's not something that a lot of people like, but it's a must. So let's talk about taxes for dispatchers, trucking companies, and truck drivers. So this will be a part of a series of videos where I will be talking about taxes. And in this first video, I want to be talking about some general things that will interest everyone in trucking industry and maybe even further. But in future videos, we will be talking specifically about doing taxes as a dispatcher, the trucking company, etc. So before we begin, I want to say I'm not an expert. I'm not a professional. Please advise your CPA, your tax guy, your bookkeeping guy, and ask them about anything that you're not sure about. This is only for informational and maybe also entertainment purposes. This comes from my experience as a trucking company owner, a dispatching company owner, a driver, and I spoke to a lot of people, to a lot of accountants, to my CPA, read a lot of things, and experienced a lot of things as far as taxes go. So I want to share some of that experience. Now, in this first video, we will be talking about a few topics that you see here on the screen, differences between LLC and S corp. Well, it's not a difference. It's I just want to explain to you how all that works. Filing taxes from abroad. That means if you are working from abroad, you have a company registered in United States, but you don't live here. You're not from here. You don't even have a residency here or social security number. We want to talk about deductions for your taxes. You know what's tax deductible. Dependents, we're not going to talk a lot about that because that's normal things for anyone that does taxes. It doesn't have to do much with business. Depreciation for equipment, we want to talk about adjusted versus gross income. So adjusted gross income versus gross. Self-employment taxes and itemizing your deductions versus standard deductions. All right, so I'm going to stop sharing the screen and I want to talk to you about these things. I made some notes here for myself. So first, we're going to talk about LLC and S corp. So I see a lot of people talking about like, hey, you should have an S corporation instead of an LLC. Now, that statement is contradictory because in order to uh, have an S corp, and it's not even an S corp, an S corporation, that means that's just a way of filing taxes. All right, you classify your company as an S corporation. And usually that means that you will have to have a company already established, and usually it's an LLC company anyway. So you can have LLC company without being elected as an S corporation, but you cannot have an S corporation without a company. So first you have to start a regular LLC, and then you will have to fill out a form with an IRS. I think it's 202053 or something like that. You can find it on internet. Just type in how to elect your company as an S corporation. All you have to do is fill out that form, and it's better if your CPA does it for you because they have more experience with that. And once IRS approves that status, then you can file your taxes as an S corporation. Keep in mind that you can't just all of a sudden decide that you're going to elect your company as an S corporation. You have to apply for it. And for example, today is January 1st. Today, when I'm recording this, it's January 1st of 2024. Now, if you want to file taxes for last year, for 2023, as an S corp, it's way too late. You have to apply for that status right now until March 15th. And that's usually because most companies will do their taxes on an annual basis from January 1st to December 31st. So that's their fiscal year usually. And that means that you have 2 months after that and 15 days to file for S corp. So if you file right now, that means that you will be able to, if IRS approves it, you will be able to file as an S corp next year for the 2024. So now it's too late. But remember, you only have until March 15th this year. If you do it later than that, then it means you're gonna have to wait another year until you're able to do that. Okay, S corporation is kind of like they call it pass-through income. All right, so there's a lot of things you can save some money if you're filing your taxes as an S corporation, maybe like a couple of thousand a year, depending how much you make, how much your business makes in a year. So you can save some taxes if you do that. It's easier to send portions of your taxes, every month or every quarter to IRS if you know that you're going to have to pay taxes. If you're going to have profit at the end of the year, that means that it's going to be easier for you to pay the taxes in advance. Also, S corporation being a pass-through income means that your company at the end of the year, if you owe taxes or if you're in negative, it means that your company will not pay it, those taxes. It will go to your personal income taxes. For example, if your business made $20,000 in profit, the gross adjusted income at the end of the year is you have $20,000 in profit. That means that $20,000 will go, it will carry over to your personal taxes. And that means that you will have to pay the taxes from your personal money. Okay, so at the end it's the same, but it will not be. You don't have to do it through your company. So this is nice if you have a partner and if you're 50-50, and let's say you have a profit of $20,000. So since you're sharing everything 50-50, then you will get to pay $10,000 from your taxes. It will go to your personal taxes, and the other $10,000 will go to his or her personal taxes. Same thing if you're in negative. For example, you had a loss at the end of the year of $20,000, then that will reflect on your taxes as well. What does that mean? It means simply that let's say you had another job, you were doing something else full-time or part-time, and you were paid from a company on a W-2, and let's say you made like $40,000 in that company, and that company has been withdrawing the taxes and Social Security and all of that, federal taxes, state taxes. That means that if you made $40,000, then these $20,000 will go on top of that. So that means at the end of the year, your gross adjusted income will be $60,000. So now you will have to pay the difference, like whatever you didn't pay, now you have to pay to the IRS. Same thing if you had a loss. That means that let's say you had a loss of $20,000 and you made $40,000 in your regular income through the company you were employed through. So this loss will be deducted from those $40,000. So now you actually made $20,000. And since the company where you worked most likely deducted taxes from your pay, that means that you were not supposed to pay that many taxes. So the IRS will refund the difference for the remaining $20,000 that you paid. So you overpaid that, and they will send it back to you. So that's what's nice about S corporation. Now, filing taxes from abroad. This topic is really somewhat unclear. Um, from what I've been reading, and I also spoke to my CPA, and I have been with him for a long time, at least 15 years, doing my taxes with the same guy. And this whole time we have been doing business taxes for several companies at the same time. And I asked him about that, and he said, I read some other articles, even on the IRS, that if you live abroad and you open up a company in United States, for example, an LLC, and you have never been here, you don't have a residency in United States, you're not a citizen, you don't have a social security number, they all agreed that you don't have to pay any taxes in United States, even though you have a company here, because and that's for the simple fact that there is no how are you going to pay for it, especially if you have an LLC and S corporation. Since this is a pass-through income, it has to go to your personal taxes. And since you're not doing personal taxes here, you don't have a social security number, there is no way to tax you. So all of them agree that, but IRS does say that you are supposed to pay the taxes in the country where you live. So for example, if you made your profit was $20,000 for the year here in the United States, and you transfer that money to yourself in the country where you live, that means that you are still obligated to pay those taxes to the country where you live, where you reside in. So that's what they say. I did read some articles where they claim that you still have to pay taxes here in the United States, even though you don't live here, you've never been here, you don't have a residency here. But there are very few articles, and I'm not going to say 100% that this is the truth, but as far as I know, that there is really no way to do that, even if you wanted to. Okay. But like I said, I'm not a professional. Don't listen to me. Find out for yourself. Maybe you file in a specific state where they have certain rules. Call the state, call IRS, ask them. All right, ask them and find out. I'm sure that that's the case. All right. So next thing is deductions. There are a lot of deductions that you can deduct from your taxes, from your gross income, in order to lower the profit, the gross adjusted income. In a business, usually everything, most things that you use for your business that are crucial are tax deductible. So we're not going to go through a list of everything, but it's all self-explanatory. So it's like, let's say you're using different subscriptions. You're paying for a phone subscription, for internet, for the business, for tracking management software, subscription to DAT board, things like that. Everything that you're using for your business, your office supplies, printer paper, pens, sticky notes, everything that you use in your office, even the equipment for the office, like printers, computers, physical phones, things like that. There are some rules that IRS, like with a computer or a laptop, they want you to depreciate that. So at the end, it comes out to same, but they have some rules where you say, hey, I bought a computer, it was $1,000, then they want you to treat it same as if you bought a piece of equipment like a truck or a trailer, and they want you to depreciate that through 1, 2, 3 or more years. It depends, all right? But a lot of people will claim it right away, your CPA will know the difference if you have to depreciate or not. And like I said, a lot of these things I just tell my CPA, hey, this is, I bought a new computer, I'm paying this much, and then he knows how to classify it when he does taxes. See, most people, when they have a business, they have someone do these taxes for them, and usually that person is knowledgeable. So when you give them a list of everything, then they will um, specify that they will put everything where it's supposed to go. And a lot of these things you don't even know what they're doing. You're just assuming that something's going on, but they don't have to tell you that. They just put it in, and their software knows what to do with it. And then having that said, also keep in mind when you do taxes with your tax guy that um, people will say, "Hey, you're the person that does your taxes. They don't know what you're doing. Therefore, you had to pay more taxes. Like it seems to them that you are paying too many taxes and or too much taxes, and that you need a better CPA, better accountant for that." Well, look, everything you tell your CPA, like what your expenses are, the deductions and all of that, and even how much money you made, they just put into their system. They're not going to check your receipts, like what you actually paid for something. Whatever you tell them, they will put it in. Okay. If you tell them, hey, this is what I paid for, they don't need your receipts, and they just go by trust. Now, if you tell them, hey, I'm cheating, I'm inflating these bills, then they're going to say, hey, well, no, I can't do that. It's illegal. I cannot go with that. Don't tell me any of that. Um, if you get audited by IRS, then they will ask for those receipts. Now you have to prove that you actually paid for those things, like your receipts and bank statements, things like that. But when you do the taxes, you don't have to have any of those receipts. Whatever you tell the CPA, the accountant, they will put it in, and they will just put in your taxes, and then the final results is what it is. Okay, so the CPA does not have any control of that. They can advise you to tell you, hey, did you forget about this? Hey, you can claim this, you can do this, don't do it this way, do it that way. Yes, they can do that, but the actual amounts, you have to be prepared when you go to them and you tell them the amounts. All right, you write down everything on the paper and then just present it to them, and they do it. Another thing with deductions is that a lot of people will forget some things that they can claim. Like I said, it's usually most of your subscriptions that you pay, everything for your business. Let's say there are two scenarios. First scenario is if you have a business, an office dedicated for the business, or if you're working from home. So in both cases, if you're using these subscriptions strictly for the business, usually everything is 100% tax deductible. All right, you can claim the 100% of that. But if you are if you have a dedicated room, and I advise everyone to do that, like if you're working from home, you should have a dedicated room for that, and then treat that as your office, and everything that you keep in that office, everything that you use for your business should be tax deductible. Now, if you are using, like if you have a dedicated office phone with a dedicated phone number, that's usually also tax deductible. But if you have a cell phone that you use for your personal business, for your personal matters, and then occasionally you use it for the business, you can also claim that. But if you tell the tax guy that this is your cell phone, they will put it in. But what you don't know, that not 100% from that cell phone is tax deductible. All right, I'm not sure what the actual rate is. There's a percentage of that, but the software knows. All right, so you can't, even though you're thinking you're claiming everything, you're actually not claiming everything. Also, if you are renting a room from yourself, so let's say you own a house, or even if you rent a house or an apartment, you have that dedicated room. You figure out that let's say that room takes up like 25% of the whole area in your house, then you can claim a 25% worth of that, whatever you're paying for the rent or for the mortgage. You can claim it as if you're paying someone else rent. Okay, so for example, you pay $1,000 a month for rent, then you can claim like $250 for that as rent. You can show it as an expense. But also, like I said, talk to your tax guy and ask them if that's okay. If that's because IRS wants you to be reasonable. They don't want, like, you can't claim 100% or 80% of that, but just be reasonable. Okay, so that's all they're asking. Okay, so most like I said, most things you can deduct, everything that you buy for a business, even meals. Now meals also are not 100% deductible. Like you can, people say, hey, I'm just gonna save this. Like I went to business lunch, now I'm saving this receipt, it's tax deductible. Well, there are limits. Okay, there are limits, and your tax guy will also know how to treat that. Okay, also there is mileage for your car. For example, if you are using your car to go to store to buy supplies, or you going visiting your driver, something like that, they have you can either do it, claim the miles, and they have a certain rates per mile that you can claim. So for example, you tell your tax guy, hey, I drove 2,000 miles last year, and it was business related trips, then they multiply those 2,000 miles times the current rate, and then you can deduct that amount from your gross income. Or you can claim, you can save your fuel receipts, registration. I don't think you can do insurance for the car, but that's mostly it. All right. Now we're going to talk, and then I'm going to talk more about the deductions when we go, because I want to make separate videos for a dispatcher and truck driver and trucking company. Okay. Now, dependents, that has to do with your personal taxes, but just keep in mind that the more dependents you have, specifically children, then or it also depends, like if you're feeling if you're married and feeling jointly or feeling separate, but usually dependents are children, and you claim the number. Like if you have 3 children, you put down number 3, and every year they have different brackets and different amounts for each dependent, but then that automatically is deducted from your gross income. For example, if you can claim $2,000 per child, and if you have 3 children, then that's $6,000, and that automatically gets taken from your taxes. You don't have to pay taxes for those $6,000. Now, depreciation, that's more if you have equipment, if you have trucks and trailers, and like I said, some like even laptop or computer, IRS sometimes wants to do it that way, depreciate it. What depreciation means simply is that you can claim some of that money for whatever, however much you paid for that equipment. For example, you paid $50,000 for a truck, and it doesn't have to be cash. It can be a loan. So you paid $50,000 for that truck, then you get to claim $50,000 on your taxes. Now, it used to be, they keep changing it. It used to be that you can only divide it through a certain number of years. For example, if you claim it to like 3 years, let's say 3 years, so 50,000 divided by 3 is like 16,500 or something. Let's just say 16,000. Now, every year you will claim $16,000 for that truck. So you buy a truck this year, it's $50,000. And then also it has to do matters like in which month you bought it, okay, in a year. So your tax guy will ask you that. They will ask you like, when did you buy the truck exactly, like what was the date, was it March or June, and you tell them that, and they will claim 15 or $16,000 for that 1 year. All right, now your gross income will go down for those $16,000, and then next year again, and the next year again. Now I think with new codes that you can even um, uh, claim more for each year. I'm not sure. I think you can even do everything in 1 year. But like if you start 1 year with like you say, hey, I'm gonna claim half this year, half next year, you cannot change it next year. You cannot go like, hey, okay, last year I claimed 50%, this year I claimed 25% of that. I You can only do 50% first year, 50% second year, that's it. Or you can do 33% first year, 33 next year, and 33% at the next year. So that's how depreciation works. Also, if you sell that truck and you depreciated everything, you claimed everything, but you make money. Like for example, you sell the truck for more than what you owed, or you already depreciated everything, but you didn't pay it out. Now you're making some money, and I had that happen to me a few times. You know, many times. You depreciate everything, and you make some money on the truck, because I made some money on a few of my trucks because I bought them when we had normal times. And then last like 2 years ago, where we had those crazy rates, all the truck equipment went up, and I sold many trailers and trucks for way more money than what I paid for. Okay, so then I already depreciated those. I made money. Now I have to pay taxes on that. So, for example, you made $20,000 on that trailer. You have to claim those $20,000. That's your income. It's taxable. So many people don't know that, and many people don't count on that at the end of the year. Then they get surprised. But what's nice about that income is that you don't have to pay self-employment taxes, and we will talk about self-employment taxes later in this video. So self-employment taxes are the biggest ones, like where you have to pay a lot of money. All right, so that income, from that you don't pay self-employment taxes. Okay, adjusted versus gross income. The other day, and that's actually what made me make these videos. I was looking at the Facebook group, and lately, like I never looked at those groups, but lately I just wanted to kind of go out and see what people are talking about and how they feel about the industry. And I see a lot of things that are just not true, and a lot of people are misleading others, like they're claiming something that's totally not true. So there was this one instance where a guy said, and I don't remember the exact numbers, I'm just going from my memory. So this guy said, hey, guys, last year my profit, and he put it this way, like my taxable income was $60,000. So I'm assuming it was the gross adjusted income. And there's a difference when you get your 1099, because we as independent contractors, if you have your own business, it's 1099. So, for example, a truck driver will make $200,000 in a year. That's just an example. So, let's say a driver is driving 50 weeks, 52 weeks, and it's 4,000 average every week, because a lot of times, some drivers will not even drive for a month at a time. Like they take a vacation, trucks break down, holidays, things like that. So let's say, I remember when we had okay times, everyone was making between $200,000 and $300,000 gross. So that's the gross. But after, they can claim all the expenses after that, like fuel, maintenance, the like the meal, meals deductions when they're on the road, insurance, interest, things like that. And then I forgot. I'm gonna go back to that for depreciation, the interest. But so let's say you made $200,000 as a driver, and now you put down all your expenses, and then your tax guy comes out with a number of $60,000. So your profit after you tell them all your expenses, everything that you can claim, everything that you were possibly able to find to be tax deductible. And the tax guy's like, hey, your gross adjusted income is $60,000, and that's your profit. And you have to pay taxes for those $60,000, not for the $200,000, because that's your gross income. You actually pay taxes for the profit, which is $60,000. A lot of people will have big things to deduct, like depreciation. That's why a lot of people will buy new equipment, change equipment, buy trailers, sell their own, buy a new trailer so they can claim it. And usually they do it at the end of the year so they can claim it for the same year. So if they buy a trailer for like $40,000, then they can claim maybe like $10, $15, $20,000 for that year. And had he had some equipment to claim, then he could have maybe lowered his gross adjusted income to like $20,000 or $30,000. Okay. But in his specific case, I'm assuming he didn't have anything else to claim. And I had those years where you don't have a lot of things to claim. And now he has to pay taxes for $60,000. And he was saying, hey, I have to pay $17,000 in taxes. Does that sound right? Everyone's like, no, that's way too much. You're not supposed to. Well, your CPA sucks. They don't know what they're doing. You should find a new tax guy. Well, I'm thinking, if his profit is $60,000 and he has nothing else to claim, then he has a problem. That number sounds right. $17,000 sounds right. If he was able to find more deductions, or if his, maybe his CPA could have advised him, tell, hey, how about this, what about that? But if they came up with everything that they possibly could have, then this is it. That's the number. That's the number. Why? Because you have to pay these self-employment taxes. You have to pay federal taxes, state taxes, and local taxes, depending if you live, like I lived here in Grand Rapids for a while, for many years actually. I don't live in Grand Rapids anymore. It's like the city next to it. But Grand Rapids has city taxes. And I had to pay, it's, even though I wasn't making that much money, like when I first came here, like 20 years ago, I had to pay like $500, $600, $700 every year just to the city. So those are your regular taxes. And those taxes, even if you're on W-2, if you're an employee, you still have to pay those taxes. But the nice thing is that your employer will deduct those taxes from your check, and you never even see that money. You don't even have to deal with that money. But if you are self-employed, it's on you to pay those taxes. And most people will not pay it right away. Most people like, hey, no, I just need the money right away. And there are some people who will pay in advance, after they get a big tax bill. But a lot of people are just like that. They will not pay those taxes until they have to. But then also when you are working for someone, you're an employee, you share these these are not self-employment taxes. These are your Medicaid and what was the other one? Social Security taxes, Medicare and Social Security taxes. You have to, it's like 15.3% altogether. You split that with your employer. So if you are employed, with someone, they pay 7.5 of that percent, and you pay other 7.5. Okay, but if you're self-employed, you pay 100% of those Social Security taxes and Medicare, which is 15.3. So on top of federal taxes and state taxes and local taxes, you also have the so-called self-employment taxes, and that altogether can easily be between 15 and 25% of your taxes. Let's just say 20%. So just know that at the end of the year, whatever your gross adjusted income is after all your expenses, in this case, this guy had $60,000, you will pay around 20% to the IRS. Okay, and 20% off of those taxes. What was it? 12,000. Okay, so he maybe had other taxes that he had to do. We don't know, but no, I think his was like 65. So he was at $17,000. So $65,000. That sounds about right. He had to pay 17,000. Okay, so don't be surprised if you get a big bill like that. Okay, so those are your self-employment taxes. Now I wanted to go back to the depreciation thing, just so you know, you can depreciate your equipment, your trucks, your trailers. But your payments for that are not. In that case, they are not tax deductible. So if you have a payment of $1,000 for a truck, you cannot claim that payment as an expense. You can claim the interest from that. So that's why you will need statements from that specific equipment, and at the end of the year, or a report that you can get at your bank telling how much interest you paid in total for that, if you had a loan for that equipment. Now that interest is tax deductible, but not your whole payment. But see, it's all nice because you can depreciate the whole amount for the truck or trailer plus the interest. But you cannot, in this case, of course, you cannot on top of that claim the payment, because that would be claiming double or more for what you paid. Now, we want to so that those were self-employment taxes. So we spoke about that, and then also itemized versus standard, and this has to do also more with personal taxes. But I just wanted to tell you, and because most people for some reason don't know this, you can on your personal taxes, you can itemize everything, same as if you're doing with your business, but you have to have all the receipts and hold them for, I think it's 6 years. If IRS audits you, you have to have all the receipts for that as proof for whatever you itemize. So what's the how does that work? See, when you do your taxes, the IRS has brackets for each year, and it changes every year. Usually it changes. You can have a standard deduction if you're a single and you're doing your taxes as a single person. You can, for example, you made $50,000. You can claim $13,850 for last year, for 2023, and just write it off of your taxes, just like that, because IRS thinks that as a single person you will have that many medical bills, charity donations, things like that. There are a few things that you can itemize, but they just give you like a lump sum and you can just deduct it. And most people, that's way more than what they actually paid for medical bills or charity or things like that. So you just automatically deduct it from the $50,000 that you made. So that means that now you have 37 or 36,150, I think, So you will pay taxes only on those 36,000. That's why a lot of people will get money back at the end of the year, and because of dependents and other things. If you're married, you can claim $27,700 just like that. It's your standard deduction, and they deduct it from your income, and you don't have to pay taxes for that. Now, there is another option where you can itemize. Let's say you made a lot of donations, but you also have to have. I think that we're like a charity or a nonprofit that you gave donations to, they have to be, I think, 501c3 classified with the IRS, and you have to have the receipt, okay, a proof that you actually paid them. Or if you had a lot of medical expenses, there was a surgery or something like that, and other things that you can itemize. And if they were at the end, when you add them together, if they came out to being more money than these standard deductions, then that means you can claim all of that on your taxes. Now, some people will, like, when they do taxes, they're going to be like, hey, I better save this. Like, I gave $500 to charity, or $1,000 or $200. I better save that. And then also they paid if they have a mortgage, because mortgage interest is tax deductible as well. They will save that, and they will give it to their tax guy, and they're like, hey, this is all the receipts. But usually that doesn't make any difference, because you're doing standard. You don't qualify to be classified as someone who can itemize deductions. You're not even near it, and it doesn't really matter at all, whether you give them those amounts, because at the end your tax guy is just going to be like, oh, okay, thank you, and they like do standard deductions for you, because this doesn't make any sense. So a lot of people, like, they will save everything, but these amounts are not that great, and they don't do any difference on your tax. Okay, so this is the first video, and then hopefully I can make these other videos soon, very soon, where we can talk specifically about dispatchers, truckers, and trucking companies. This is Enis. Thanks for watching. Like I said, if I said something wrong, please correct me. If you have any other suggestions, let me know in the comments. Thank you.